Good morning. It's Monday, the 14th of October, and this is Govindraj Ethiraj headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The Take. In 1930, Colgate-Palmolive listed on Wall Street more than 100 years after its founding as a starch, soap, and candle business in New York City. In 1937, a decade before independence and 7 years after it was listed on Wall Street, it arrived in India with its Colgate dental cream. I usually think of Colgate when someone asks me about India-US economic relations, as I was at a recent and small gathering of leading communications professionals from world over. The specific question was about the impact of a Donald Trump or Kamala Harris presidency in the United States, and I really struggled to think of what could change so dramatically. For instance, what could change for an all-American corporation like Colgate, who has been in India for close to a century now, and with public shareholding for close to 50 years or half that time? So why pose this question? Well, there is a new angle, and that is iconic motorcycle brand Harley-Davidson, a Midwest, Wisconsin-based company that's younger by almost 100 years as compared to Colgate-Palmolive. Presidential candidate Donald Trump raised the issue of India's high tariffs on Harley-Davidson bikes last week in an interview on Fox News. Actually, he raised the same issue in the context of Harley in 2017 as well, referring to a 100% tariff level, though both India and Indonesia at that time had similar tariffs. Trump's point now was that America should slap reciprocal taxes on countries like India. Could that happen? Well, the interesting thing is that Harley, like many other auto companies and giants, have over time accepted the fact that the best route to the Indian market is to have local manufacturing or assembly, which Harley itself set up in 2010 before launching its range of bikes. However, around 2019, Harley said it was shutting shop because of lower than anticipated volumes and, of course, high tariffs. But exactly a year later, it returned, this time in partnership with Indian two-wheeler giant Hero Motors. The strategy this time, smaller sized bikes, local partner, and of course more affordable price. For example, the X440 range, which is made in Neemrana, Rajasthan and sells for around 2.4 lakh rupees, much lower than its original lineup of motorcycles. Now, Harley's path is somewhat similar to Ford, who of course has entered and exited India 3 times, the last being the latest entry last month. For Trump, there is political mileage in aligning with a brand like Harley, which is an all-American, though actually and obviously not as large or nowhere as large as a car brand like Ford or General Motors. And General Motors, speaking of which, has also exited India after a not-so-happy run, incidentally. But Harley's own actions are more practical and pragmatic, as its latest moves show, including its desire to return to the Indian market, just about the largest two-wheeler market in the world now as it crosses China. On the other hand, India's policy has been consistent and focused on encouraging local manufacture and job creation, except for a brief interlude earlier this year when it looked like policymakers would cave into Elon Musk's charms and allow imports of Teslas without a local plant, or at least for some time. Now, there is still some heartburn, incidentally, among other global car makers on India's electric vehicle policy, and it would be interesting to see how that evolves if Trump were to be elected and Elon Musk starts playing a role in government, that is, the US government, even if distant, but as has been suggested. So that's a discussion for another day. The bottom line is that self-interest will drive most, if not all, economic policy for both countries. India's automotive market is amongst the most competitive, open and fair markets in the world, and in some ways a benchmark in this globalized world. In 1999, in an amazingly prescient observation, then Ford CEO Jack Nasser said he saw Ford as a local manufacturer and exporter and wanted to harness India's brainpower in IT. Moreover, he was against imports and quoted the example of countries like New Zealand, where imports had killed the local car industry. It struck me later that automotive leaders like him were also against imports because they were now vested and invested in India. Harley-Davidson seems to have concluded similarly, as has Ford in its subsequent avatar. Maybe Trump's new avatar, if he were to be elected next month, would view things a little more pragmatically as well and in India's favor. And that brings us to the top stories and themes for the day. The stock market search for footing even as Wall Street hits fresh highs. FIIs sell close to $8 billion in 9 sessions, the China fear factor. Banks get ready for climate and disaster resilience. Noel Tata takes over as head of Tata Trusts. And airfares are falling in peak season.
This is a Core Report with Govindraj Ethiraj.
The markets lose footing. Last week was interesting, as in it was quite evident that the stock markets were struggling to find a firm footing. Another word for that is consolidation, after the BSE Sensex closed down 230 points at 81,381, while the NSE Nifty 50 was down 34 points at 24,964. In the broader markets, the BSE mid-cap and small-cap indices actually did well, ended with gains of about 0.5% each. Now, if you were to look back, both the Nifty and Sensex are down about 5% from their record highs hit on September 27th, not very long ago, but have lost in 8 of 10 sessions subsequently. Foreign institutional investors have sold Indian shares for the last 9 sessions, offloading about $7.8 billion or close to $8 billion worth of stock as they directed flows to China after it announced those bumper stimulus measures, Reuters reported. And more on that China factor shortly. The question is, could Wall Street's Friday performance act as a beacon? Well, I'm not sure. It seems unlikely, though the S&P 500 and the Dow Jones Industrial Average hit new highs, driven to some extent and interestingly by banking stocks, and is also thus reflecting a widening of the market beyond tech, apart from an expectation of a strong third quarter. The Dow Jones was up close to 409 points to finish at 42,863. The S&P closed at 5,815. The Nasdaq Composite, which is tech weighted, as you know, is still 2% below its all-time high. Back home, the rupee has crashed below 84 rupees to the dollar for the first time ever on Friday, thanks to those portfolio outflows and rising oil prices. Speaking of oil prices, they've eased off somewhat, but are still kissing $80 a barrel as traders continue to watch for Israel's potential retaliation against Iran. So Brent is currently quoting around $79 a barrel. The markets are also waiting to see if China's latest stimulus measures could boost demand, which is flagging in the world's largest importer of crude oil. Meanwhile, Bloomberg reported that in yet another sign of flailing demand, BP PLC, or erstwhile British Petroleum, said that lower margins from processing crude will hit earnings by $400 to $600 million, which also adds to similar projections from other giants like ExxonMobil and Shell. The China factor. A slew of brokerages reduced their India weightage and increased it for China the last few weeks as they raced to catch the latest rally in China following the stimulus measures there, which is at this point, however, looking like it is running out of steam. The numbers do tell some part of the story, with FIIs having sold close to $8 billion worth of stocks in barely 2 weeks. Not surprisingly, because brokerages like Jefferies and CLSA, among others, have indicated that they've increased their China weightage and reduced it for India. While all of them stand by India's medium to long-term story, no one is clearly sticking their neck out on the current market, given, of course, their discomfort with valuations here versus those in China. Now, this does present a fresh perspective of sorts to flows, though given that the assumption was India was pulling flows regardless of China, or at least to some extent, which does not seem to be the case now, though some fund managers have said while there is and will be some rotation, both markets will draw separate strands of flows. I reached out to Jay Kothari, lead investment strategist and global head of international business at DSP Mutual Fund, and I began by asking him how he was seeing the China factor play out from a FPI or a foreign portfolio investor vantage point, also in the context of many of these investors that he speaks to frequently.
In terms of what's happened over the past couple of weeks is that in the run-up to the expectation of the NDRC press conference and what will come out of that and a huge stimulus which was expected from China, a lot of kind of market participants tried to start building that. And in the run-up to that, there was a lot of kind of flow which went to China. And only to realize on the day the announcement of the NDRC came through that it was slightly underwhelming than what markets were expecting. So it was more and expectations built up, which led to this entire flow into China. And even now, with the Ministry of Finance giving out the announcement tomorrow, which is 12th of October, the expectation is that the package will be close to $550 billion. So that's the bare minimum, which should come, which is 3% of GDP. Anything underwhelming, markets will correct. Anything better than that or close to $1 trillion, that'll be very positive. So I think I wouldn't worry too much in terms of that this is going to be a do or die situation. This was investors who are underweight on China. They're just building up the gap or bridging the gap. Usually what they tend to do is that they will kind of invest if there's a clarity in terms of economic policy and earnings. If there's any kind of disappointment, that probably momentum can stop, at least what has got built over the last couple of weeks.
Right. And how does India stack up in this? I mean, the reason they seem to be saying they are now underweight India is because obviously of valuations, not because there's anything wrong with the structural story.
Absolutely. And I completely agree with that, because what's happened is that India has seen a relentless amount of flows over the past 2 years, disproportionate flows coming in. Plus, has outperformed. China has underperformed and has not seen flows. So that's why, this entire shift which you've seen flows coming to China. So, since August 2023 till now, whatever outflows you had seen in China, maybe 50% is bridged with the $15-16 billion China has got over the past couple of weeks. And half of this has gone from India. So, we were $11 billion inflow by FPIs at the end of September. Now, almost $6 billion has moved out in the past couple of days. Probably that entire thing has gone into rotation. And most importantly, that rotation is within the Asia cohort, which gives you a sense is that, they have nothing else to sell. So they're selling India and just kind of shifting weights. But, once dust settles, probably, we'll be back to normal.
Right. And when you say normal, what is the next 3 months or so looking from both the domestic flows and one is the flows, which is the supply side, but the other is the demand side and how companies will perform and whether or not fund managers will deploy as much as maybe they could or would?
Yeah, I think there is a mix back there. So in terms of the earnings, incremental earnings expectations and delivery seems to be low and has been slightly disappointing. On the other hand, the state election, which we saw recently, Haryana kind of definitely surprised on the positive side from a ruling government standpoint. And in terms of the Maharashtra and Jharkhand elections, which will come through in the next couple of months, that will have probably a positive momentum. Apart from that, maybe the tax cuts from the US, despite all what's happening, will give that positive fillip in terms of, what RBI does. And in terms of the tax collection remains all right as far as India is concerned. CapEx is slightly, again, underwhelming. So therefore, I mentioned it's a mixed bag. So going forward, I think the focus should be on the domestic assets, which kind of continue. They've been relentless. YTD, we've seen $40 billion of flows, which is a mix of mutual funds and insurance companies, of which $30 billion is mutual funds, $10 billion is insurance. And I don't see any reason why this SIP, which is a structural story, to continue. So I think that will continue. And plus the slew of IPOs which are coming, which is probably a supply which is kind of meeting with the demand, which, we are continuing to see from mutual funds and insurance companies.
But these are really big IPOs with, of course, Hyundai leading the pack. Does that worry at all?
So I think this would worry if the supply was far exceeding demand. So, I was reading somewhere that in a single day, you saw 15 filings of IPO. I think it was today or yesterday. I don't know, maybe probably yesterday. There have been 40 in the month. So which tells you that there is definitely a euphoria building up in terms of expectations and a lot of kind of companies are coming through. But in terms of demand and supply, I think it is kind of matching, at least at the moment.
From a foreign portfolio investor outlook, in terms of as you talk to them, I mean, what is the thing that would interest them or what is the thing that they will find interesting in, again, the next 3 to 6 months?
No, I think they will continue to look at valuations, earnings, anything got to do with, policy, politics in terms of continuity. And more importantly, the corporate kind of move. So we've heard about the rural slowdown last few years. Now that's kind of at the cusp of turning. So if that momentum continues, so it's going to be the framework, growth, earnings, valuation. So growth probably continues to chug along well. Earnings is something which is a mixed bag after a few years of positives, and valuations, if now the relative valuations start looking slightly more normalized, because mind you, just a few months back, if you had asked me this question, China was trading at 8 times. Now it's trading at close to 11 times. So, dynamics have changed. So it's more of relative attractiveness. And if we are able to kind of sustain earnings, I think India is in a all right spot. Of course, you will see those odd corrections because a few stocks and sectors are expensive. So it needs to kind of course correct. And more importantly, if you have anything less than maybe 6 to 12 months of investment horizon, that makes you vulnerable. If you have anything got to do with more than 3 years of investment horizon, I think it's a no-brainer. Over the next 5 to 7 years, India is here to stay.
Good note to end on. Thank you so much, Jay. Great to talk to you.
Thank you. Thanks, Govind. Thank you.
Financial institutions prepare for disaster resilience. The Reserve Bank of India last week announced the setting up of a data repository to monitor climate-related risks. The repository, called the Reserve Bank Climate Risk Information System, or RBSERIS, will include a web-based directory and a data portal forming climate-related data sets. How that will work, we will come to shortly. The web-based directory will list various data sources like meteorological, geospatial, which will be publicly accessible in the Reserve Bank website, the governor of the Reserve Bank said. while announcing the monetary policy. While the second part of that initiative will be a data portal comprising of data sets which will be available to regulated entities, presumably like banks, in a phased manner. The larger point, of course, is that the banking and financial system would and should increasingly use data and evidence to protect their loans to projects which could face climate risk challenges. Such an assessment requires, among other things, high-quality data relating to local climate scenarios, climate forecasts, and emissions, the governor had said. For example, it would be important to understand and project the impact of heavy rains in coming years to, let's say, even major real estate projects in terms of timely execution and delivery, or a running airport where operations could come to a halt and equipment damaged because of extreme weather conditions, of the like we're already seeing around the world and in India. The Reserve Bank of India's deputy governor had also said recently that climate change had the potential to create shocks to monetary stability, growth, financial stability, and the safety and soundness of regulated entities, which again would mostly mean banks. Climate-related events adversely impact the credit quality and loan repayment capabilities of borrowers, the deputy governor had said, adding that these can wipe out the assets created from institutional finance, thereby impacting the health of financial institutions. The Reserve Bank is also working towards framing a comprehensive environment, sustenance, and governance policy, and there are various moving parts within that. I reached out to Amit Prothi, urban planning expert and Director General of the Coalition for Disaster Resilient Infrastructure, or CDRI, a India-headquartered partnership of national global governments, along with multilateral development banks, the private sector, and educational institutions who are promoting resilience of new and existing infrastructure systems. I began by asking Amit how he was reading the RBI's latest announcements.
Govind, thank you very much for having me, first of all. I know we've had some conversations about the topic of risk and the need for data to be in the public domain. You may recall we had actually launched something on the risk to infrastructure sectors called GIRI, with the intention that if one can start to provide information which is consistent, reliable, in a location where everybody trusts, it can then lead to other branch. You can branch out and do other things with reliable data. And I think for me, the first thing of what RBI is doing is, if they become the repository of data, they become the ones who are essentially saying what we are sharing is reliable data on risk, on climate parameters, then one can at least start as an investor, as somebody who wants to understand their portfolio of assets and what risks they may be facing. You can go and say, okay, that becomes a starting point. What are the data sources that RBI is telling us are acceptable? I think what that will lead to then is, if I'm an investor and I need to understand more fine-grained, if I may have a manufacturing unit in a location, I may be investing in an infrastructure, I can go and say, okay, RBI is giving me this data. There is a data set behind it that I can access, which is more proprietary. It may be something I can access. And then you can ask your private sector partners, because at the end of the day, the private sector will come in, take what RBI is putting out as sources of data and start coming up with reliable tools that are dependent on that data. So it creates a market for tools and solutions. The starting point for those are at the same place, which is again the RBI's, source of the platform that they're creating, right? So there's a lot of opportunity, but I'll stop there.
Yeah. So, and data will be, I guess, a gap for anyone who's in the climate risk mitigation, climate risk addressing ecosystem. If you look at some of the successes or let's say examples from elsewhere, including elsewhere in the world, what's your sense about how far we've come in terms of capturing data and then using that data to better arm ourselves or prepare ourselves, whether it's governments or private sector and so on?
Yeah. So I think it's always a struggle where on one end, you need to have data. On the other hand, you need to know how to use that data, right? So the two parts of this equation. On the data side, reliable data, consistently updated data, data that is easily understandable, easily accessible. You are confident it's coming from the right sources. That's the data side of it. Then you need to be able to interpret that data. And I think that's where when we have seen, even the GIRI model that we put out, it is a lovely set of data set. That's lovely data set, but then using it is where now we are spending time trying to train people, build capacity, share how you can use it, come up with use cases. I'll give you an example. The FEMA, or the Federal Emergency Management Authority in the US, agency in the US, puts out something called flood maps. They've been doing that for a long time. They're only sharing that data, and that's a reliable set of flood maps. Now, there is a whole insurance industry that uses those maps. When you're purchasing a house in the US, you're actually being asked to look at, are you located in that floodplain according to FEMA's maps? And that determines your insurance premiums, or you may not have insurance, right? So it's how do you interpret and use that data that requires a lot more effort. And I think that's one of the spaces for CDRI. Actually, we are starting to think about how do we get to develop some capacity building initiatives for the financial sector to start to use the data sets that will be put out by RBI, start to interpret, climate change is to some extent an uncertain science. So how do you look at those data sets in a way that you can be more, your decision making can be better?
So let me ask you a slightly forward question here. So if you were to look at your own work, let's say, for example, in airports and other infrastructure areas, where do you think lies maybe the more immediate need, or in terms of priority, where do you feel data needs to start flowing fast or first?
So because our work is in the infrastructure sector, and because we're still young as an organization focused on three sectors, I'll say all three sectors, right? Power, telecommunication, and transportation. When you look at climate risk to infrastructure, this is where our global database of risk points that to the power sector is actually one of the most vulnerable to climate change. Telecommunication is most vulnerable to climate change. And then you start getting into the issues of, what are the locations, places that are most impacted by changing hydrometeorological conditions. So flooding in cities, coastal wind, cyclones, etc. So there is a link between what the changing hazard patterns because of climate change and the infrastructure types that are most vulnerable to those changing patterns. And power, telecommunication are two that are coming up very highly on the sort of risk profile because of climate change risks. There's a whole sort of other risks, but because of climate change risks, these two sectors are quite vulnerable.
Right. And last question. So, as this database gets constructed, is there any area that you feel bodies like the Reserve Bank, which is a financial regulatory body, need to maybe stay focused on or highlight more?
I would love to see the whole discussion going towards incentivizing adaptation. So, once you have reliable data and once you're able to do some scenario analysis to understand your risk, there would be an opportunity to think about how do you incentivize adapting to those risks. Because again, it's not that everything is a disaster. Understanding your risk is also an opportunity. You could be at the front end of new technology. You could be on the front end of new solutions. If you actually starting from a point of saying, I need to understand my risk, because if I understand it, I can then do something about it. And this is where financial instruments to incentivize, what we call adaptation measures would be wonderful to see actually.
Right. That's a good note to end on. Amit, thank you so much for joining me.
Thank you so much, Govind. Always a pleasure.
Industrial contraction sets in. India's industrial output contracted for the first time in nearly 2 years thanks to weak mining activity and lower electricity generation. Reuters reported government data on Friday saying industrial output fell marginally, that's 0.1% year on year in August, contrary to expectations of economists of a 1.2% growth in a Reuters poll. The index had previously registered a contraction in October 22 when it fell 4.1%. Manufacturing output rose about 1%, but electricity generation has fallen 3.7% and mining activity fell 4.3%. So it's electricity generation and mining which is causing the problem. An economist at ICRA said the marginal contraction in August 2024 is not alarming as it largely reflects the temporary dousing of mining output, electricity demand, and retail footfalls by heavier than normal rains. Heavier than normal rains, of course, have been blamed by many sectors of the economy, including the automotive sector, saying that people were not turning up at car dealerships because of heavy rains, and before that, it was severe heat waves. Noel Tata takes over. Noel Tata, the late Ratan Tata's half-brother, was appointed on Friday as the head of Tata Trusts, the philanthropic arm of India's Tata Group, which has indirect but fairly firm control over the $165 billion conglomerate. Tata Trust said that Noel Tata, who's 67 years old, will be its new chairman after the passing of Ratan Tata, and the decision followed many old-timers in the group wanting to lead the venture, one Tata executive quoted by Reuters said. Tata Trust owns about 66% of Tata Sons, giving it veto power of sorts, but also reflecting the societal ownership and philosophy of founder Jamsetji Tata. Tata Sons is headed by N. Chandrasekaran, formerly CEO of TCS. Noel is currently chairman of Trent and vice chairman of Tata Steel, and was seen as the face of Tata Group's retail growth and expansion, including brands like Westside and Chroma. Tata Sons owns about 30 firms, including brands like Jaguar Land Rover, Tetley Tea, the homegrown Tata Consultancy Services, Taj Hotels, and now Air India. Airfares drop. Speaking of Air India, average airfares on many domestic routes have dropped 20 to 25% compared to a year-ago period, according to an analysis quoted by Business Standard. The reasons attributed are increased capacity and a recent fall in oil prices, though oil prices, as I can see, are headed back up as we speak, and that could change things not too far down the line. But the larger question, of course, is demand and how strong that will be through and beyond this year's festive season, something I can assure you a lot of marketers are watching very closely. The airfare drop analysis has been attributed to travel portal Ixigo and focuses on domestic routes. As I said, according to this analysis, the maximum decline of average airfare is about 38% for a Bangalore-Kolkata flight to about 6,300 rupees from about 10,195 last year. The average airfare, more importantly, for a Mumbai-Delhi flight has dropped about 34% from 8,788 to 5,760. And there is a 34% decrease in prices on the Delhi-Udaipur route, again from last year. So last year's surge could also have been because of sudden capacity drops, which have now got adjusted. Though select routes have, of course, seen jumps as they always do, like a 34% rise on an Ahmedabad-Delhi route and a similar rise on a Mumbai-Dehradun route. More on all of this in a few weeks. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.